Right now, in vaults across New York and Chicago, a number is falling. It fell last week. It fell the week before. And when it crosses a threshold that almost nobody outside the professional trading community is watching the silver market, a market that has already produced a 31% single-session swing in the last 30 days, will face a structural test it has never encountered in the modern era. The registered silver inventory at COMEX, the metal that is actually available for delivery against futures contracts, stands at approximately 98 million ounces. The paper contracts written against March delivery alone represent roughly 340 million ounces. That is a 3.4 to 1 ratio. Not across the whole market, just for March, just for the contracts coming due in the next few weeks. Here's what that means in plain language. For every ounce of silver that exists in deliverable form in registered COMEX vaults, there are 3.5 paper promises to deliver it. And those promises are about to be called. This is not a fringe theory. The data is published every business day by the CME Group. The CFTC reports the positioning weekly. The numbers are there for anyone willing to read them. What is not widely understood is what happens when that ratio collides with a simultaneous set of pressures that have been building since late 2025. Chinese export controls now entering their third consecutive month. Shanghai physical silver trading at a premium of roughly $10 over COMEX paper prices, 4 consecutive margin hikes from CME already executed, and SLV redemptions that have pulled approximately 29 million ounces out of the trust year to date. Every one of those forces is pulling in the same direction, toward a physical delivery market that is tighter than the paper price reflects. This video is not for everyone. It is specifically for the person who already holds a meaningful position, 100 ounces or more, in silver in any form. Physical bars, ETF shares, futures, mining equities, allocated storage. If your silver position at Friday is close of 84.40 per ounce is worth $8,000 or more, what follows is the most operationally relevant analysis you will receive heading into this particular week. Because the risks you carry, the decisions you face, and the mistakes that could cost you are categorically different from someone holding 10 ounces as a curiosity. The week beginning February 24th, 2026 is not a normal market week. March delivery pressure is real, the structural distortions are measurable, and the volatility conditions that produced that 31% intraday swing on January 30th have not eased, they have compounded. To understand exactly what you are holding and exactly what you need to do before Monday's open, we need to start with the architecture of the position itself, because most silver holders, even experienced ones, cannot fully articulate the specific risk profile of what they actually own. The 100-ounce threshold is not arbitrary. At current prices, it represents approximately $8,440 of capital, the level at which a silver position transitions from a hedge or a hobby into a financial holding that demands the same strategic attention you would give any other significant asset. Below that threshold, a 10% market move is uncomfortable but manageable. Above it, a 10% move is $844 or more per 100 ounces. The January 30th intraday move of 31% represented over $2,600 per 100 ounces. At 500 ounces, that single session produced a $13,000 swing. These are not projections. They are documented market events from 4 weeks ago in a volatility environment that has since intensified rather than normalized. The first thing any serious holder needs to establish is the precise structure of their position, because the word silver covers a spectrum of instruments with fundamentally different risk profiles and failure modes. Physical silver held in personal possession, coins, bars, rounds in a home safe or secure storage, carries the narrowest counterparty risk profile of any silver instrument. No custodian can lend your metal. No exchange can margin call you out of existence at 6:15 on a Sunday evening. No trust prospectus can substitute cash for metal under extraordinary circumstances. Your exposure is limited to theft, physical damage, and illiquidity. That last point matters more than people appreciate at scale. Selling 100 or more ounces of physical silver quickly at a fair price is not as simple as clicking a sell button. Local dealers may not carry the cash to absorb large quantities at spot. Online dealers require shipping, insurance, authentication, and settlement windows that can stretch days. Before this week begins, a physical holder at the 100-ounce level or above should have identified at minimum 2 local dealers and 1 online dealer capable of handling large transactions, verified their current buy spreads relative to spot, and understood their payment timelines. Exit channels should be established before they are needed, not during a price event when spreads widen and decisions compress. SLV holders face a structurally different set of exposures. The trust holds roughly 560 million ounces, custodied by JPMorgan, priced against COMEX paper benchmarks. Under normal conditions, this is a liquid, efficient instrument. The current conditions are not normal. SLV experienced $3 billion in redemptions during January 2026 alone. The custodian simultaneously operates as one of the largest COMEX silver deliverers and holds one of the most concentrated short positions in silver futures, a structural conflict that is irrelevant during stable markets and highly relevant during delivery stress. The specific risk for SLV holders is that paper physical price divergence could cause SLV shares to track COMEX paper downward while physical spot prices remain elevated. That divergence has already begun. Shanghai physical silver is trading at roughly 94 boer to 95 against COMEX paper at 84.40. SLV tracks COMEX, not Shanghai. If this structural picture is starting to sharpen, if you're seeing how the instrument you hold shapes the risk you carry, hit like and subscribe, because the delivery mechanics we're about to walk through take this from structural analysis into immediate actionable territory. PSLV holders operate with fully allocated metal at the Royal Canadian Mint, with published serial numbers and independent verification. The counterparty risk profile is materially cleaner than a bullion bank custodian. But PSLV trades at a premium to net asset value, and that premium can compress during selling pressure. A holder who purchased at a 4% premium faces 4% of premium contraction risk entirely independent of silver's price movement. At the 100-ounce equivalent level, that is approximately $340 of exposure that has nothing to do with the silver market itself. Futures holders carry the most acute near-term risk. Each standard COMEX silver contract represents 5,000 ounces, $422,000 of notional exposure. With maintenance margin at $23,000 after the fourth consecutive hike, that is roughly 18 to 1 leverage. A 5.5% adverse move against your position eliminates your entire margin. January 30th's 31% intraday move would have produced losses of $130,000 per contract. The question for futures holders entering this week is not whether the market will move. It is whether their margin structure can absorb the moves that the current environment is demonstrably capable of producing. But knowing your instrument is only the first layer. What comes next is where the specific risks of this particular week converge into something that demands a written plan before Monday's open. Here is the specific mechanism that makes the week of February 24th different from an ordinary volatile week in silver. March is a major COMEX delivery month. First notice day, the date by which futures holders must declare their intent to take or make delivery of physical metal, is approaching. The window between now and first notice day is the period of maximum structural tension between the paper, futures market, and the physical delivery system that is supposed to back it. The numbers that matter. Open interest for March contracts represents approximately 340 million paper ounces. Registered COMEX silver, the metal actually eligible for delivery, stands near 98 million ounces. The ratio is 3.4 to 1 on March alone. This is not the total COMEX inventory, it is the deliverable inventory. The gap between what is promised on paper and what exists in registered form for delivery has been a persistent feature of the silver market for years. What is different now is the simultaneous presence of every other distorting pressure at the same moment March delivery stress peaks. Chinese export controls on silver, implemented in late 2024 and now entering their third consecutive month, have effectively removed a major source of physical supply from Western delivery chains. There is no historical precedent for this specific disruption running this long without reversal. The impact on Shanghai premiums has been measurable and widening. Shanghai physical trading at $10 or more above COMEX paper is not a curiosity. It is the market's real-time signal that physical silver is valued materially higher than the paper price reflects. When that divergence is wide and persistent, it creates an incentive for market participants to stand for delivery at COMEX rather than roll contracts forward, which is precisely what places stress on registered inventory. Meanwhile, 4 consecutive margin hikes from CME have changed the financial calculus for leverage longs. Each hike increases the capital required to hold futures positions, forcing undercapitalized longs to close positions regardless of their market view. This is not neutral. It is a mechanism that systematically advantages well-capitalized participants over retail and smaller institutional holders. The 4th hike has already executed. A 5th is a live possibility this week if volatility metrics trigger CME's internal thresholds. The Sunday evening Globex open at 6 p.m. Eastern is the first data point of the week. The historical pattern over the past 14 months shows silver has opened below Friday's settlement in approximately 64% of Sunday sessions, with an average first 30-minute decline of 0.8% to 1.2%. At current prices, that pattern, even if it triggers, represents a potential move to 83 to 83.40 before full market liquidity returns Monday morning. For futures holders or anyone in leverage positions, that is a $500 to $700 mark-to-market loss within the first half hour before a single London trader has opened their platform. The question for every holder above the 100-ounce threshold is not whether these forces are real. They are documented, measurable, and ongoing. The question is whether your current position structure and your current plan can absorb both the bullish scenario, delivery demand exceeds expectations. Price spikes toward $90 and above as the market scrambles to incentivize physical sellers, and the bearish scenario, delivery standing proves manageable, contracts roll smoothly. The crisis narrative loses near-term momentum and price retreats toward $75 or below under continued margin pressure. Both outcomes are legitimate probabilities. Neither should surprise a prepared holder. And if you think those are the full boundaries of what this week could produce, the structural fragility that sits underneath all of it goes considerably deeper. The prepared holder and the unprepared holder will hold identical positions at the open on Monday. By Friday, their outcomes could be separated by decisions made or not made before tonight at 6 p.m. That gap is not a function of market prediction. It is a function of written planning executed during calm conditions, before fear or greed enters the equation. This is the concrete work that determines outcomes. Every holder above 100 ounces needs a documented cost basis for every position they carry, not an approximate recollection, a specific number, because that number determines everything: your tax exposure on any sale, your psychological anchor during drawdowns, and your actual risk tolerance for adverse moves. A holder who purchased 100 ounces at $25 per ounce sits on approximately $5,140 in unrealized gains at current prices. They can absorb significant volatility without touching principal. A holder who bought 100 ounces at $75 per ounce has $940 in gains on a $7,500 investment. A 12.5% price decline erases every dollar of profit. A holder who bought at $110 during January's spike is currently underwater by approximately $2,560. These three people have identical positions by ounce count and wildly different risk profiles, decision frameworks, and psychological vulnerabilities. They should not be making the same choices this week. The 30-day written strategy is not optional at this position size. It requires 4 specific answers committed to paper before tonight. First, what percentage of your position are you willing to sell under any circumstance in the next 30 days, and at what specific price triggers? Not a vague sense of maybe at 95, or a specific number of ounces at a specific price level, written down and kept accessible. Second, what additional capital are you prepared to deploy if price dislocates downward, and from what source? Third, what is your absolute maximum pain threshold? The price level at which you exit your entire position regardless of your long-term thesis. Because the market's capacity to stay irrational has exceeded your capital's capacity to stay solvent? This number must exist. Without it, you're making your worst decision at your worst moment. Fourth, what does success look like at 12 months? A specific target price provides the context that transforms a $75 dip from a panic event into a potential accumulation opportunity, if your written plan identified it as such beforehand. Here is a question that deserves serious consideration before Monday's open. If registered COMEX silver inventory falls below 90 million ounces this week, while March delivery standing exceeds expectations, what does that mean for the 560 million ounces of silver nominally backing SLV? And for the paper price that SLV tracks, rather than the physical price that Shanghai reflects, the mainstream financial press is not asking this question. The people whose capital depends on the answer should be. Drop your analysis in the comments where you think the paper-physical divergence goes from here and what your own position structure looks like heading into this week. The most precise and well-reasoned responses on this channel consistently come from holders who've done the structural work, and I read everyone. The final area of preparation that most analysts ignore because it generates no excitement is insurance documentation. A holder with 500 ounces of physical silver at home holds roughly $42,000 in portable value. Standard homeowners insurance typically covers precious metals for $200 to $500 without a specific rider. The gap between coverage and holding is not a minor oversight. It is a catastrophic, uninsured exposure that theft, fire, or natural disaster can permanently close. Every physical holder should verify their coverage limits with their insurer today. Every bar should be photographed with serial numbers visible. Every purchase receipt should be organized and stored in a secure location separate from the physical metal. These are the risks statistically more likely to produce permanent losses than any single market event. Volatility is temporary. A house fire with no documentation and $500 of coverage is not. There's a tendency in volatile markets to conflate conviction with preparation, as though believing strongly enough in an outcome is itself a strategy. It is not. Conviction tells you why you hold silver. Preparation tells you what you do when the market moves against you at 6:17 on a Sunday evening. When your margin account sends an automated alert when the price drops $4 in 20 minutes, and your hand is on your phone deciding whether to act. In that moment, the only thing standing between you and a decision driven entirely by adrenaline is a piece of paper with your own handwriting on it. Written when you are calm, that tells you exactly what you already decided you would do. That is the infrastructure this week requires. Not prediction, not access to information that only professionals possess. The COMEX Vault data is published daily by CME. The CFTC positioning reports are released weekly. SLV's holdings and trust prospectus are public documents. Shanghai premium data flows through the SGE. CME margin schedules are posted as exchange advisories. Every data point that matters to understanding the current structural condition of the silver market is accessible to any holder willing to go find it. The informational asymmetry is not that institutions have data you cannot access. It is that institutions have systems for acting on data, and most individual holders do not. The 5 areas of preparation before tonight ends open are these. Know the specific structure of what you hold and its distinct failure modes. Know your precise cost basis for every position and what it implies about your actual risk tolerance. Have a written plan for both the bullish and bearish scenarios this week, with specific price triggers and specific actions. Verify your insurance coverage against your physical holdings and organize your documentation today. And commit in writing to a 30-day strategy with defined exit levels, defined addition levels, and a defined absolute floor. The silver market in February 2026 is not a normal market. The combination of March delivery pressure, depleted registered inventory, sustained Chinese export controls, widening Shanghai premiums, 4 executed margin hikes, and unprecedented paper-to-physical ratios has produced a structural configuration with no clean historical parallel. That does not mean catastrophe is certain. It means the range of outcomes is wider than normal, the velocity of potential moves is higher than normal, and the consequences of being caught without a plan are more severe than normal. Both directions are possible. A delivery crisis that forces COMEX to reprice silver toward physical reality would reward prepared holders who held their positions. A managed roll cycle that diffuses near-term pressure would reward holders who had defined downside plans rather than panic selling at the worst moment. The market does not care about your conviction. It does not reward belief. It rewards preparation, the kind that happens before 6 p.m. on Sunday, not at 6:15 when Globex opens and the position is already moving. Silver has always been the market that punishes hope and rewards homework. The people who will carry their positions through the next 30 days with their capital intact are not the ones with the most certainty about what happens next. They are the ones who planned for uncertainty before it arrived. Write the plan, verify the data, know what you own, protect what you have built. The market opens in hours. The preparation window closes before it does.